Stock picking, the endeavor of selecting individual stocks for investment, is often portrayed as a battleground between two opposing forces, art and science. Some investors approach it with the meticulousness of a scientist, poring over spreadsheets and financial statements, seeking quantifiable data to guide their decisions. They believe in the power of numbers, ratios, and historical trends to unlock hidden value and predict future performance. On the other hand, there are those who view stock picking as an art form, relying on intuition, experience, and a deep understanding of market sentiment. They trust their gut feeling and their ability to identify promising companies with strong growth potential, even if the numbers don't immediately scream buy. The truth, as is often the case, lies somewhere in the middle. Successful stock picking is not an either-or proposition, but rather a delicate dance between these two seemingly contradictory approaches. It requires a blend of analytical rigor and creative thinking, a combination of objective data analysis and subjective judgment. To truly excel in the stock market, one must embrace both the science and the art of investing. This means developing a solid understanding of financial statements, valuation metrics, and market dynamics while also cultivating the intuition and flexibility to adapt to ever-changing market conditions. Ultimately, the goal of stock picking is to identify companies with the potential to outperform the market over the long term. Whether you lean more towards the analytical or the intuitive, the key is to develop a consistent and disciplined approach that works for you. Remember, the stock market is a marathon, not a sprint, and success comes to those who can combine knowledge, skill, and a touch of artistry.
Before diving into the numbers, it's crucial to understand the company behind the stock. What does the company do? What products or services does it offer? Who are its customers? And what is its competitive landscape? These fundamental questions form the foundation of any sound investment decision. Think of it like this. You wouldn't buy a house without first inspecting its foundation, plumbing, and overall structure. Similarly, investing in a company without understanding its business model, its industry, and its competitive position is like buying a stock blindfolded. Begin by researching the company's history, its management team, and its overall industry. Look for companies with a clear and sustainable competitive advantage, whether it's a unique product, a strong brand, a loyal customer base, or a combination of these factors. Remember, investing is not just about numbers. It's about understanding the story behind those numbers. The more you know about a company, its industry, and its competitive landscape, the better equipped you'll be to make informed investment decisions.
Growth is the lifeblood of any successful company. It's the engine that drives stock prices higher and creates long-term value for investors. When analyzing a company, pay close attention to its revenue and earnings growth rates. Are they increasing consistently year over year? Are they outpacing the industry average? Revenue growth indicates the company's ability to attract customers and generate sales. Earnings growth, on the other hand, reflects its ability to control costs and translate those sales into profits. Ideally, you want to see both revenue and earnings growing at a healthy clip. However, be wary of companies that prioritize revenue growth at all costs. Sometimes, rapid revenue growth can mask underlying problems, such as declining margins or unsustainable business practices. It's crucial to look beyond the top-line number and assess the quality and sustainability of that growth. Remember, sustainable growth is not about chasing the highest growth rates, but rather about finding companies that can consistently increase their revenue and earnings over the long term. These are the companies that will ultimately create the most value for their shareholders.
Section 4. The balancing act, returns, and the cost of capital. Investing is all about putting your money to work and earning a return on your investment. When analyzing a company, it's essential to consider both the returns it generates and the cost of generating those returns. Return on equity, or ROE, and return on invested capital, or ROIC, are two key metrics that measure a company's profitability and efficiency in using its capital. ROE measures how effectively a company is using its shareholders' money to generate profits, while ROIC assesses its overall efficiency in allocating capital, including both debt and equity. However, returns are only part of the equation. You also need to consider the cost of capital, which is the minimum return a company must earn on its investments to satisfy its debt and equity investors. If a company's returns are consistently lower than its cost of capital, it's essentially destroying value even if it appears to be profitable on the surface. Look for companies that can generate returns that consistently exceed their cost of capital. These are the true value creators, the companies that can reinvest their profits at high rates of return and compound shareholder wealth over time.
Section 5. The price is right. Valuing a company's worth. Determining whether a stock is overvalued or undervalued is a crucial aspect of stock picking. While the market generally reflects the collective wisdom of investors, it's not always perfectly efficient. There are times when a company's stock price may not accurately reflect its intrinsic value, creating opportunities for astute investors. One way to assess a stock's valuation is to compare its current price to its earnings, sales, or assets. This involves using valuation multiples, such as the price-to-earnings ratio, price-to-sales ratio, or price-to-book ratio. However, it's important to remember that valuation multiples are just a starting point. They don't tell the whole story. A company with a high price-to-earnings ratio, for example, may be overvalued, or it may simply be reflecting high growth expectations. Conversely, a company with a low price-to-earnings ratio may appear undervalued, but it could be signaling underlying problems. The key is to look beyond the numbers and consider the company's growth prospects, its competitive position, and its overall industry dynamics. A company with a high price-to-earnings ratio but strong growth potential and a wide moat may still be a good investment, while a company with a low price-to-earnings ratio but declining earnings and intense competition may be best avoided.